Good Monday morning, 30 minutes till the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, an end in sight. Democrats concede on health care, setting up a potential breakthrough to end the longest shutdown in U.S. government history.
And an end to that shutdown would help lift the data fog for a divided Fed. This hour, we're going to hear exclusively from Alberto Musalem of St. Louis.
Meanwhile, on the corporate front, the AI bubble debate rages on as chipmaker TSMC reports a slowdown in sales.
It's one of the stocks we're watching this morning, Matt, because even though they reported a slowdown, shares are still higher. Let me show you what a lot of these tech AI kind of names are doing. TSMC, the ADR up 2.5%, AMD up 3.3%, Qualcomm 1.6%. So it was in line with analyst estimates what TSMC gave, and the stock and its main customers, all of these, are moving higher alongside the broader tech market because tech had such a bad week last week, so there's a little bit of dip buying going on, too.
Yeah, it turns out maybe we cared about a government shutdown. Health insurers like Centene and Oscar are falling as lawmakers move closer to ending that shutdown, but without getting anything that the Democrats wanted in terms of health care extension. You can see Centene actually down 7 2/3%. Oscar Health down further, more than 8%. HCA Holdings, which has already been pummeled, obviously down another 5.5%, Dani.
So a disappointment for the insurers that maybe we won't get the ACA extension, but for the rest of this market, it rejoices. After 40 days of deadlock, the Senate has kick-started the process to end the shutdown. It will reconvene in 2 hours from now. Then the bill would head to the House if passed. President Trump discussed the bill's progress at the White House.
Looks like we're getting very close to the shutdown. We'll never agree to give any substantial money or any money to really prisoners, illegals that come into our country. And I think the Democrats understand that. And it looks like we're getting close to the shutdown ending. You'll know very soon. Thank you very much.
John Harney, an editor for Bloomberg News in Washington, joins us now. John, how close are we to ending the shutdown?
This seems like the end game, the beginning of the end. However, you have 535 lawmakers, so things could still go wrong. Now, the House is still out, as it has been since September. The members are coming back. That will take a day or so. So we could see the government reopen, perhaps by Friday.
The last I heard from Chuck Schumer, he's not for this deal. Elizabeth Warren says it's a horrible deal, and Hakeem Jeffries says his caucus is going to vote against it. So how does the math work?
Well, about 10 Democrats, I believe it was 10 Democrats, split from the Chuck Schumer's ranks to say that they would support ending the shutdown and take this offer that had been on the table by John Thune to vote on several appropriations bills that would fund different departments for an entire year and keep other agencies in operation till the end of January in exchange for a vote on health care subsidies, which led to the shutdown in the first place. So Democrats did not get the subsidies enacted, which would have been their goal. However, they did certainly call attention to health care, to the health care problems health care issues that many Americans face.
All right, John, thanks very much. John Harney there in Washington, D.C. Let's get to tech now, because TSMC reported a 17% rise in sales for October, so an increase, but at the slowest pace since February of 2024. Bloomberg Intelligence head of global tech coverage, Mandeep Singh, joins us here at the desk. So is this a slowdown that we should be worried about?
Well, so for a company like TSMC, which has a diversified business, I mean, we are all focused on AI, but AI is still, about 15% of their overall revenue. So I think what may be in play here is the impact of AI capex on the non-AI hardware spend. If anything, this is a lasting trend. We don't know because there is seasonality in the monthly numbers. So it could happen there, third month of the quarter may actually end up growing 40%, and then they'll still be over 30%. But with that being said, I think there's a real risk that some of that non-AI spend is getting hurt because of all the AI capex, and that could be showing up in TSMC's numbers.
You did see some of that concern really play out last week. A lot of the big cap AI-related names hurt. CoreWeave being one of them fell 22%. They're going to report after the bell today. Considering they're one of these companies that kind of exist in this weird circularity, everyone investing in each other, do those types of earnings matter even more, not just for CoreWeave, but for the hyperscalers too?
I mean, look, when it comes to AI capex, we know Microsoft has committed $60 billion to neoclouds. Just to CoreWeave and Nebius, it's like $30 billion. So from that perspective, when I look at the book of business that CoreWeave has and the contract durations, like they have $30 billion in RPO. That's going to get converted into revenue over the next 4 years. So from that perspective, I don't think there is anything to doubt with a company like CoreWeave, which is a pure play AI capex play. Look, these are depreciating assets. So what I'm interested in knowing is what will happen to CoreWeave's margins 2 years from now. And when you have to write off a lot of these GPUs that have a life of 3 years, that's when the impact on gross margins is really important. But for now, the revenue and top line looks really strong here.
I look at the S&P broken down in industry groups over the last 5 trading sessions. IT was the biggest hit, down 4.25%. So last week, communication services, those are the hyperscalers, the second biggest hit. So it was definitely tech stocks that let us down last week. But now I'm starting to think maybe the government shutdown mattered in the trade. Do you think any of that sort of infected the exuberance for AI?
I mean, right now, everyone is focused on what the hyperscalers are going to do in terms of CapEx. And we know 2025 was a more than a 50% growth in CapEx. Chances are 2026 will be another year where CapEx from hyperscalers grows in excess of 50%. Now, that's huge when you think about, the numbers we're talking about, $550 billion plus in aggregate revenue in CapEx. So I don't think there's anything to worry about in terms of AI infrastructure right now. But there are pockets that may be getting hit on the non-AI side because everyone is diverting their spending towards AI. And shutdown or not, I think you will see some sort of an impact over there.
I can't help but chuckle at that question because it is kind of ridiculous, right? Like the shutdown's over and AI is rallying.
I know, but it's happening.
It's literally happening.
Yeah.
So yeah, make of that what you will.
Maybe government spending gets a lift, if shutdown is over.
Mandeep, I love you assigning reason to what feels reasonless. Mandeep Singh, thank you so much for joining us.
I will say the good news is I'm so happy to get Mandeep's take, but later on we're going to get Cliff Asness' take on this too, because it is seemingly what happened.
Yes.
Right? The government shutdown hit us hard enough to beat down AI, and now we have all of these AI companies, including those that have slowed growth, rising on the end of the government shutdown.
Right. Well, you have a guy who has systematic strategies that has to assign rules to things. How do you do that in today's market, again, when things seem like nonsense? Okay, let's move on to a deal this morning. Metsera, the saga there, shares of the weight loss drug maker tumbled after Novo Nordisk pulled its bid, paving the way for Pfizer to close on its deal with Metsera. Bloomberg managing editor for global business, Shelley Banjo, joins us now. Shelley, what a saga it has been. At one point, it seemed like Novo was kind of in the lead for this thing, considering Pfizer was going so far as to sue them. What changed that allowed Pfizer to pull away with it?
Yeah, one Wall Street analyst called it the Real Housewives of Big Pharma. So that's the twists and turns that this has taken over the last week.
That fits too. That's very fitting.
And what changed, to your question, is the U.S. government. So the FTC came in, gave a call to Metsera, which they put in their press release and said, I really don't think that if you're going to go with Novo, you're going to have some problems. So take another look at it.
Wow. So pressure from the government, keeping, I guess, the foreign bidder out. And it makes sense, right? Because Pfizer had done a deal with President Trump first and curried favor with the White House. But does this really help them get on the board when it comes to the obesity drug race? Because it still is Novo versus Lilly, right?
Yes, definitely. And Novo, we could sort of argue that Pfizer needs this more than Novo does, but Novo's not doing so hot itself at the moment, and it does need some of these next generation, second generation drugs here. But with Pfizer, I mean, they have just been hitting it, losing after losing after losing with obesity, discontinuing drugs that aren't working, and they really need a win. And so the question is, is this going to work out for Pfizer? It's a $10 billion bet that it's going to get them back into the game.
All right, fascinating story. Looking forward to more reporting on that out of Shelley's team. She covers corporates for us here at Bloomberg. Let's get a check of what's going on in futures this morning. As we've been saying, talk about an end to the government shutdown, even if we don't completely understand how it would work in the Senate, because anyone could stop it, is really boosting stocks. S&P futures up another 0.9%. We were already up. We finished Friday higher, even though for the week we were still down.
Yeah, the worst week since early April. So some of the other movers on our radar this morning, there were some other earnings. Tyson's, for example, those shares are moving higher by almost 4%. It expects earnings for 2026 to be little change compared to this year, that despite beef prices at a record high.
Gold miner Barrick maintained its full-year production target and raised its quarterly dividend. As a result of that and the end of the government shutdown, the shares are up 5%.
Actually, gold is doing better today because of the end of the government shutdown, right? Isn't it? I think gold's higher, which also doesn't make a lot of sense.
It is true. Spot gold is up to over $4,000 now, $4,089 a troy ounce. Instacart finally here providing an upbeat earnings outlook as orders grow at a healthy clip. I don't know what a healthy clip is, but orders are growing.
They're growing. Yeah, that's the net sum of that. All right, coming up on the show, U.S. Airlines cut flights, a chaotic weekend for travelers, more on the headwinds facing airliners, and maybe what the end of the government shutdown does to them. That's all coming up on Bloomberg Open Interest.
It's getting out of high interest. Look what's making headlines around the world. Former French President Nicolas Sarkozy will be released from jail after serving 20 days of his 5-year sentence linked to an alleged campaign funding from Muammar Gaddafi's regime. A Paris court approved his release while he appeals the conviction and ordered that he remain in France. Sarkozy, who was held in solitary confinement, called his time behind bars a nightmare. The 70-year-old maintains his innocence with appeal hearings expected next year. Citadel is launching a new stock-picking unit in London as it expands its European footprint. The division will take larger, longer-term stakes in European companies, marking a shift from Citadel's faster trading style. The move comes as multi-manager hedge funds like Citadel race to put record inflows of capital to work. And heavy snow in Chicago is adding to nationwide travel chaos as the government's flight restrictions enter a fourth day. More than 10,000 flights were delayed or canceled yesterday, and airlines warn more disruptions are likely with fresh snow falling. The gridlock comes as the shutdown drags past 40 days, leaving air traffic controllers unpaid and straining the system ahead of the busy Thanksgiving travel window. Dani?
Let's get more on the impact from that travel disruption. We're joined by Bloomberg's chief correspondent for global aviation and transport, Sid Phillip. Sid, I mean, no surprise that this weekend was insane. Government shutdown, the weather. How much does that affect the airlines themselves?
It does affect the airlines because, one, you have all these passengers who are stranded. Two, you've got aircraft and crews that are out of place. And that means you have sort of relocation flights, aircraft are not in the right place at the right time. And that sort of adds chaos to a system which is already sort of, they're having to cut flights and having to sort of make changes on the fly. And that sort of makes things much harder for the airlines.
So there's a snowball effect here, I imagine, right? No pun intended, but I just can't believe things get any better rather than worse over the next few days as we get bad weather in Chicago, it snows there, and the government shutdown, even if we have a solution by Friday, still is going to hurt this week.
It is going to hurt this week. I mean, we're seeing the government already talking about restrictions that will ramp up to 10% by the end of the week. And so the longer the shutdown actually lasts, I mean, we're still not quite sure when the shutdown will actually end. And the longer this lasts, air traffic controllers still aren't being paid. You still have restrictions on flight and the bad weather. So it's all going to sort of snowball into more cancellations, more delays, and more frustration for travelers at the airport.
Enough so that it would extend into Thanksgiving, or if there's an end this week, it could be cleared by then?
It's still to be determined how quickly the government rolls back these restrictions, and also what the other mitigating factors in terms of weather and other things are. So it's still up for debate whether Thanksgiving travel or not will be disrupted, but we will have to sort of see.
Nonetheless, we see airlines doing well. I mean, you can see on the sidebar here, Southwest is up in the pre-market, American Airlines is up in the pre-market, United Airlines is up in the pre-market. So the rally in the shares doesn't reflect the chaos on the ground.
I mean, we did see sort of the shares take a beating while they talked about the restrictions, and so they say sort of a more positive approach, saying that, okay, air travel might be back given the fact that the government shutdown looks like it's ending.
It was a period, though. We saw, for example, on Friday, the latest University of Michigan sentiment survey, where it looked at the lowest since 2021. These airlines have reported people who are willing to pay up for things like business, who are enthusiastic about traveling. A period like this, could that go some way to dent that sentiment? It
could dent sentiment because people who are sort of more willing to travel might hold off and might think twice about booking travel, especially as they watch the chaos unfold. And so we still have to wait and see what the booking trends look like when the airlines sort of give us more of an update as to what the impact of this shutdown and the restrictions were. But in terms of sentiment, it definitely plays into sentiment.
I mean, the airline stocks in general, at least the big ones, right, have all rallied since Liberation Day. So they were higher at the beginning of the year, but they took a huge hit into April. And since then, they're all on the uptrend, at least United, American, Delta. Does this put that at risk?
I mean, United and Delta had great results, and they talked about how they have consumer base that isn't as affected by inflation and higher prices because they are sort of more immune to those things, and they've sort of gone more premium. They've sort of changed their aircraft mix to add more premium seating, and that's why we've seen the low-cost carriers struggle a little more. But in terms of sentiment, yes, there was the airlines also cut their estimates for the year when the Liberation Day tariffs came around because they weren't quite sure what the economy looked like. And then they've sort of been more bullish and more optimistic about the prospects for next year. So that's why airline stocks have been where they are.
All right, Sid, thanks so much for joining us. Sid Phillip is our global aviation correspondent. Let's get a look at some of the other movers on our radar this morning. Crypto-linked stocks are rising amid the risk-on sentiment as the government shutdown inches closer to ending. When Bitcoin rises, when the rest of the CRYP Go universe gains, you see these stocks rally as well.
And apparently that's part of the reason why gold is higher this morning, too. So you see gold-linked stocks also outperform. Maybe there's also an increased chance of a rate cut next month as the shutdown progresses. You also had earnings from Barrick that upped their dividend and share buybacks.
European buyout firm Invest Industrial has agreed to take food label manufacturer Treehouse Foods private in a $3 billion deal. And as a result, Treehouse trades up towards the premium. You can see the gain there, more than 20%.
Coming up on the show, Empower's Marta Norton says that volatility will remain high, so it's a good time to prioritize rebalancing. She's going to join the show next. You're watching Bloomberg TV. Morgan Stanley remains bullish on stocks into 2026, despite risks from the Fed and government policy. A note from Mike Wilson says, quote, while overhangs from Federal Reserve guidance and the shutdown have weighed on recent price action, these are temporary headwinds on a way to a solid 2026, driven by earnings growth. Joining us now is Empower Chief Investment Strategist Marta Norton. Marta, great to see you this morning. And I want to pick up on one thing that Mike Wilson said, that the government shutdown was weighing on stocks, because that's been assigned the reason while we're rallying so much today. Does the shutdown matter? Has the shutdown mattered for how you think about equities?
Well, I think what's interesting about the shutdown is that it doesn't really change the cash flows that we know are kind of the enduring drivers of equities. But I think what it did do, especially as it lasted and prolonged over time, was put a lot more uncertainty around how the economy is trending. Of course, we're missing a lot of key economic data. We're keying off of private market data that may or may not be a little bit less powerful than what we would get from the official numbers, and we're building narratives around that. And I think that just introduces a certain amount of volatility. So certainly getting the government reopened would provide some stability that I think the markets could use.
There are a lot of those issues that could cause volatility, and yet we continue to march higher and higher and higher. Okay, I know last week was an exception to the rule, first drop in 4, but how do you see this S&P 500 panning out to year end into 2026? Do we start to get real volatility again?
Well, you know, the argument heading into November was that November was a period of seasonal strength and that we should just kind of ride this wave all the way through to the end of the year. But I think the one kind of fly in the ointment and that narrative is just where valuations stand. And they just don't leave a whole lot of room for anything less than perfection. And of course, we see earnings deliver, and yet the market greeted that with a yawn, and all the sum total of all the straws on the camel's back created the volatility last week. I wouldn't suggest that there's something fundamentally broken. I resonate with the comments that say that earnings are very strong and that the AI super cycle is real. But I think what we have to remember is that when we're dealing with valuations at this level, when we have fundamental moments of doubt, DeepSeek types of moments, I think we could see some greater volatility.
All right, Marta, thank you so much. You're going to stick with us. Much more to cover after the opening bell. That is Marta Norton there. A quick check on futures. Less than 5 minutes to go until the start of the opening bell. It does feel like there's relief on at least a measure that would help get rid of the government shutdown. We're higher by 1.5% for the NASDAQ. After that, fell last week, Matt. Its worst week for both the S&P and the NASDAQ since Liberation Week, since the beginning of April.
And I think the most interesting thing is that you see these AI companies like TSMC continuing to rally even after forecasting forecasting slower sales, putting out slower sales. Still gains, right, but slower accelerations there, and the government shutdown seems to be the answer to why they are up. Also coming up on our next hour, AQR's Cliff Asness joins us at the table for a wide-ranging interview on markets and the economy. This is Bloomberg. We are moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Matt Miller, looking at some decent gains here in futures on news that this government shutdown may be drawing to a conclusion. S&P futures up 0.9%. NASDAQ futures up 1.5% as somehow the end of the government shutdown gives an extra boost to the AI mega-cap tech stocks. In terms of the opening bell, you've got the CEO of Eni. This is an Italian energy company that has U.S. ADRs. They've been listed on the New York Stock Exchange for 30 years, and so they're here to celebrate. Hopefully they get some good food as well. Although, would you come from Italy to New York?
I was going to say,
food?
I mean, we have just as good food as Italy, I would argue,
yeah.
but yeah.
Go to Carbone.
They probably wouldn't say that.
In terms of the NASDAQ, Extreme Networks, which provides solutions, of course, for networking and data storage. It's all about AI, I'm sure they would tell you. And as a result, their shares are up only 4% this year, but like 260%. 270% over the last 5 years.
Wait, sorry, can I just clarify one thing? If an Italian came to New York, you'd recommend Carbone to them. That feels like a mistake.
That was a joke.
Okay, just making sure. Just making sure.
Where would you send an Italian in
Not
New
to
York?
Italian food, just like anything but Italian
But
food.
pizza. But New York does better pizza than Italy, right?
Okay, the show's gonna get shut down by a group of angry mob of Italians, so we are gonna move on from that. Some stocks to watch this morning. TSMC, they reported their slowest monthly sales growth in 18 months, but it was in sale with analyst estimates. So that's TSMC. Here are all of its main customers, but they're all rallying in what you pointed out, Matt, the fact that the government shutdown is over, and apparently that's better for sentiment, which means it's better for AI and tech sentiment, which took a big beating last week.
All right, health insurers like Centene and Oscar are falling as lawmakers move closer to ending the shutdown without a health care extension. Remember, this is what the Democrats wanted. This is why they refused to sign the clean CR. They wanted to restore ACA subsidies, and they didn't get that. Or at least they haven't thus far. And as a result, you can see that all of these insurers are getting beaten down even further. Let's bring in Empower Chief Investment Strategist Marta Norton. And You know, these health insurers have been hit so hard, and obviously since one big beautiful bill, they've lost a lot of the largesse of the U.S. government. Is there a certain point where companies like this, become value stocks that you like?
Well, you know what's interesting is really as we've gone over the course of 2025, most of the sectors, even kind of defensive areas like consumer stocks, look expensive to us relative to their own histories. And when I say expensive, they're in the 9th, 10th decile, so kind of extreme valuations. The area that has been left out on a sector basis has been healthcare. And this cuts across kind of the industries within healthcare, certainly the insurers, but also areas like pharma, biotech, all of those areas left behind, policy concerns, tariff overhangs, drug pipelines, you name it, all sorts of problems there. And so that created what we saw as a pretty good valuation opportunity. We have since seen a lot of that area rally back, particularly as some of those tariff concerns have been straightened out. But on a relative basis, there's still some value. And as you point out, insurers still an area where potentially there's absolute value, though, of course, absolute problems as well. So if you're looking to add valuation exposure to the portfolio, I think healthcare is one of the places that you could go. And at least sector-wise, you could argue that it's a bit more defensive if you have some concerns over the economy.
Marta, healthcare is also one of these sectors that's kind of like the poster child for the back and forth of what government policy has done to a lot of these companies. It was down a lot, as you were saying, because of the tariff. It gets that relief. Pfizer today won its takeover of Metsera because of the aid from the government. Within this sector and really more broadly within stocks itself, is there a strategy to say, hey, ex-CEO has a good relationship with the White House, therefore that company is a buy?
You know, what's been super interesting, again, another kind of 2025 overarching comment, has looked at the fiscal impact and the one-day reaction to that. If we're looking at tariff announcements, AI announcements, One Big Beautiful Bill Act, the fiscal policy effect has been about a 14 percentage point swing on a one-day, reaction to news, whereas monetary policy, it's been about 2%. So to your point, fiscal policy, Washington has loomed large in markets, and it stands to reason that that's going to continue to be something that we're going to be watching as we go through 2026. Now, how you formulate a strategy around that, I'm not quite sure. I do think awareness around it is step number one.
One of the groups that could benefit more from monetary policy changes than the government stepping into private company management is small caps, right?
Yeah.
If we continue to get cuts, do you like small caps here?
I think it's hard.
Do we continue to get cuts, and do you like small caps?
That's right. Well, so I guess on the cuts front, just answering that question first, I do think the Fed has one more cut in it, just reacting to how big the reset was when it comes to the jobs market and what we saw from payrolls. In fact, really not seeing anything from payrolls over the course of the summer. I do think that we will expect to see some adjustment there, whether that comes in December or not. I think that's harder to say. We're certainly seeing, that split Fed and concerns around inflation as well, which are very valid. On the small cap front, I think it's hard not to have some space for small caps in your portfolio, just given how cheap they are. But there are so many factors. There's the rate dependency, the economic dependency, the tariff effects that are hurting those companies. So I think as you have exposure, I think it's something that you should moderate, not necessarily go all in on.
And another contour of this market, Marta, that's been really interesting this year is just the prevalence of retail and just the extent that they're participating. President Trump over the weekend said that he would have a $2,000 payment to most Americans funded by U.S. tariff revenues. The last time we saw money given out to people in that way with checks handed out was during COVID. And what resulted on that was a big participation from retail investors. Could this theme just keep playing out? And how does it make you think differently about markets?
Well, the retail theme is very interesting. There's been such a dichotomy between how institutions have behaved, particularly around tariffs, and how retail investors have behaved, and the hashtag buy the dip mentality that has felt like a winning investment strategy. And I do think as you start to give more money, we'll see if that comes to pass, but certainly you will see refunds and kind of tax effects over the course of 2026 as well. It will be really interesting to watch the retail investor. I don't think that mentality is really going to shift. I do think you have support from from the retail base. The big question is those more seismic moments of doubt that I was referring to earlier, the DeepSeek types of moments that not just rattle prices, but make people question the narrative. Those are traditionally really good buying opportunities, but they're a lot scarier than maybe what we've seen thus far. So how retail responds in moments like that, I think, will be pretty fascinating.
By the way, I know that the economy is pretty awesome for the top 10% or the top quintile, but is the economy so bad for the bottom 80% that we need to be handing out stimulus checks?
I think that's a question mark. Certainly they're weaker, right? And we see that with people pointing to delinquency data. We see that when we look at what the inflation numbers have been and how difficult that's been to weather. And we see that from a housing market standpoint, how difficult it is to get into the housing market, just given the price appreciation that we've seen there. There's certainly challenges, but I don't know if we can say there's out and out weakness. And so I think that if you're looking for reasons why the economy could get a bit more frothy than maybe it ought to be, it could be stimulus at a time when we don't necessarily need it.
Hey, Marta, this has been fantastic. Thank you so much for joining us to kick off the week. Empower Chief Investment Strategist, Marta Norton. All right, about 8 minutes into your trading day, let's just see how things are shaping up. A pretty even number of winners and losers, but the overall market is up because of who is up, and that is the big cap tech. NVIDIA leads the charge, moving the overall index higher by 18 points. Amazon, Apple, Alphabet, Broadcom, it's all the big tech AI players that are doing so strongly. On the downside, you see a lot of those health insurers, HCA, one of the biggest detractors on the losing column because of the potential we don't get an extension of the ACA tax credits. That would hurt them. A lot of consumer-related names also really struggling today. P&G, Walmart, Johnson & Johnson, Home Depot, Coca-Cola. Kind of weird also when you consider the $2,000 checks we were just talking about. Sectors, you'll see a very similar thing. It's kind of the inverse of last week, whereas last week tech was down big. The communication companies were down big. Again, that's a lot of the hyperscalers. Those are what's leading us this morning, up 2% for info tech. Communications up 1.7%, whereas, as I point out, a lot of those consumer companies, the worst performers today, Matt.
All right, coming up, we head back to Washington, but this time not to talk about the shutdown. We've got an exclusive interview with St. Louis Fed President Alberto Musalem. We may ask him about the shutdown, but obviously this is going to be geared more towards monetary policy. An interview you don't want to miss on Bloomberg Television and radio. It will be simulcast. This is Bloomberg.
Are you going to climb?
Welcome to Open Interest on Bloomberg TV and Bloomberg as intelligence on Bloomberg Radio to our viewers and listeners around the world. I'm Michael McKee, International Economics and Policy Correspondent, and joining me this morning is Alberto Musalem. He is the president of the St. Louis Fed. Thank you for coming in this morning here in Washington. And we have some news in Washington that we may be getting close to the end of the shutdown, which would release data. But just in case that doesn't happen, based on what you know now, what do you think about the economy?
Mike, good morning. Great to be here. I see an economy that has been pretty resilient, where growth has been roughly around potential, around 1.8 for this year, in spite of a lot of uncertainty. I see a labor market that has been around full employment, is around full employment, has been cooling, with demand and supply have been cooling. And I see inflation, which has been closer to the 3% level than to our 2% target.
Well, we know that when the data comes out, everybody will be parsing it carefully. But is it going to add a lot to your knowledge of where the economy is and possibly change any decision you might make?
More data is better than less data, so we will learn. It always has additional value. I do feel that we have a pretty good sense of where the economy is. We have availed ourselves during this period of unofficial data dearth, let's call it that, with private sector data. We have been in close contact with all of our constituents, businesses, households, community leaders in our districts. So I feel we have a pretty good sense of the economy. But I'm very much looking forward to seeing the official data releases, because they are the gold standard. and they'll provide additional information.
Well, what are companies in your district telling you?
They are saying that consumption has been resilient. They're saying that growth has been fine. They're saying the labor market has softened a little bit. They see many more applicants per vacancy. They report compensation growth somewhere between 3.5% to 4%. So things look reasonably okay.
But the consumption that remains resilient, obviously at the upper ends you have the stock market wealth effect driving it. But I know you've been worried about the lower deciles because they're taking on more debt.
That's exactly what's happening. So we estimate that the real consumption growth of the high-income folks and of the low-income folks has been about the same. But as you said, the higher-income households are consuming from the wealth effects they have in the stock market and home prices, by the way. Lower-income folks are taking on more debt. They're taking on more credit card debt. And that's how the economy has been thus far.
Well, taking on debt to continue consumption, a cynical economist might say, where have we heard that before? And how did that turn out? Are you worried that we're setting up for a problem?
By and large, when I look at consumer finances, if you look at consumer balance sheets, by and large, for the economy, they are okay. The consumer is not over-indebted here. Now, over the past year, we saw an increase in subprime loan defaults. We saw an increase in credit card defaults. Now, over the past year, those have started to stabilize and actually come down some. But, at the lower end of the income spectrum, you always have to worry that, those consumers who live, hand to mouth need to wait until the end of the month to make it, could be strained. Yeah.
Companies, I know, have been telling you and your colleagues for some time that they're waiting for clarity, especially on fiscal policy going forward, which doesn't seem to necessarily be coming. Are any of them saying we're kind of at a point now where we have to raise prices to keep up with our input prices, or we have to cut back on people because our margins are compressing?
Two questions, two answers. Companies tell me that uncertainty has plateaued and that they can understand how to operate with this new higher level of uncertainty. So some of that is going on. In terms of pass-through of higher costs, companies are experiencing higher costs. Some of it related to tariffs, some of it related to other things like insurance, which is totally unrelated to tariffs. And companies that are upstream, so earlier in the production process, are successful in passing on those costs to other companies to build products that they build. Companies that are closer to the consumer and selling to the final purchaser of a good are having more difficulty in passing things on because they are facing some pushback from the final buyer.
The labor market, how fragile is it? We've seen a lot of layoff announcements over the past couple of weeks. Is this a gathering trend? Are we going to start talking about the Somme rule again?
I see the labor market as having cooled in an orderly way, both because supply and demand have cooled. The latest challenger job announcements, which you're referring to, I definitely took notice of them, but they don't necessarily mean the labor market, is about to go into a deterioration phase. In the same week that they were announced, as you know, the weekly claims, which are, another very good indicator of layoffs, has remained stable so far. So you have to look at all of the data in the labor market and see whether those layoff announcements will actually materialize.
In terms of supply problems in the labor market, monetary policy can't affect that.
The traditional way to think about monetary policy is that it is more effective with respect to cyclical and demand side type of factors. But I think we also need to be thinking if the economy is going through a structural transition, what role does monetary policy need to play in facilitating that transition? So we have to, in my mind, be thinking about those two things.
Now, there are two arguments that seems to be at the Fed right now. One is that we need to get ahead of a brewing problem, especially in the labor market. And the other is, if you're in a dark room, you want to move carefully and maybe pause. Which one do you think carries more weight?
The way I think about it is I feel we have adequate information to make decisions to cut rates or not to cut rates. For me, it's about the outlook that I happen to have and the balance of risk that I happen to have with the information that I currently have. Going back to your first part of the question, in the past year, the real federal funds rate has declined by 250 basis points. Of that, 150 basis points have been reductions in the nominal interest rate to provide insurance to the labor market and to get ahead of any deterioration in it and to keep the labor market around full employment. And about 100 basis points of the decline in the real federal funds rate has been looking through the rise in expected inflation, mostly due to tariffs. So that's how I think about monetary policy right now.
Well, to the extent that they know, what are companies telling you about monetary policy? Do they say that we're going to have to raise prices or cut employees if you don't cut interest rates?
Not necessarily. I don't hear that from companies. Companies often are more concerned about non-interest costs that are increasing. For example, I mentioned insurance, but raw material costs and other costs to produce things, all the way from building homes to producing manufactured goods. And so I hear more about that than about interest costs being something that needs to be passed on to consumers. So it's very important that we continue to focus on bringing inflation back down towards 2%.
Well, we hear a lot from your colleagues. We heard from Chair Powell about the risk of cutting too fast versus the risk of not cutting soon enough. What about the risk to credibility if you cut, but then inflation doesn't go down and you have to start thinking about raising rates again?
As Chair Powell said, there's no risk-free path. And, if we focus too much on the labor market and then cut too aggressively, we can have an undesired outcome on the inflation side. If we focus too much on the inflation side and labor market deteriorates, we're going to have an undesired outcome. And so right now, what our strategy, monetary policy strategy document says is that when you have some tension between your two goals, you have to follow a balanced approach, which is to steer monetary policy to attend to both goals.
Well, which way would you steer it in December based on what you know now?
I think, again, it's very important that we tread with caution here. I think there is limited room to ease policy further without policy becoming overly accommodative. Monetary policy, in my estimation, is somewhere between modestly restrictive and neutral, probably closer to neutral. If you look at the real federal funds rate, it now is around 1%, and 1% happens to be the long-run neutral rate in real terms for the federal funds rate of the entire committee, the median, I should say, of the entire committee. So I think we need to continue to lean against inflation to make sure we bring inflation back down towards our 2% target while providing some insurance to the labor market. One thing I hear often when I visit with folks in my district is that people are having more month than money increasingly, number one. Number two, I hear that folks are increasingly going to food pantries, including middle-income folks. And I hear that aid institutions are increasingly getting requests for utility assistance, probably related to higher electricity and energy prices. I should say electricity prices. So those three things tell me that it's really important that we bring inflation back towards 2% to allow households to catch up with their real incomes.
We've only got about 30 seconds left. Markets are up this morning. They're cheered by the possibility of a shutdown deal. But when the sun comes up in the east, they've been going up cheerfully lately. Are you worried about the level of asset prices?
Financial conditions are very accommodative of economic activity and of employment. the Fed, the board just released its financial stability report, where it says that asset valuations are notable, and it's not our job to opine on particular valuations of markets. But if you look at that report, it suggests that house prices seem elevated relative to historical standards. Stock prices seem elevated. And to me, it's just the flip side of accommodative financial conditions.
Alberto Musalem, thank you very much for joining us this morning, the president of the St. Louis Fed. We'll send it back to you in New York.
All right, Mike, thanks very much. Mike McKee there with St. Louis Fed President Alberto Musalem, who said that he thinks financial conditions are very accommodative and that the economy has been resilient. He sees employment right around full employment. All of these comments lead me to believe you don't really need to cut rates that much.
No, but he is a Fed official who has believed that, who's had a more hawkish bias. You heard the inflationary bias in what he was saying, that yes, there are more lower income people who have taken on more government debt, that middle income people are going to food banks. But he basically said that inflation is the problem and that he could see a reacceleration into the start of next year. Yeah, very interesting stuff. Consumer balance sheets are okay. The consumer is not indebted, although using a lot more credit cards, and middle income people going to food banks has got to be a concern. Coming up, Cliff Asness of AQR joins us. He's going to talk about AI exuberance. He'll weigh in on that debate, plus the private capital push and his macro outlook for 2026. This is Bloomberg Open Interest. We are 30 minutes into this trading Monday. Welcome to Bloomberg Open Interest. I'm Matt Miller. And I'm Dani Berger. Equities rebound after their worst week last week since early April because, I guess, end of a government shutdown?
Coming up, an end in sight for that. Democrats concede without getting anything they wanted, setting up a potential breakthrough to reopen the government after the longest shutdown in history.
And an end to that shutdown at least would help lift some of the data fog for investors and a divided Federal Reserve with what might be a deluge of data coming once we do get a reopening.
Meanwhile, on the corporate front, the AI bubble debate rages on because chipmaker TSMC reported a slowdown in sales growth. Nonetheless, the shares rise because
of a government shutdown? Yes, yeah. Makes complete sense. And very, very logical. Let's talk about something more logical. And we begin with quant trades making a comeback this year, specifically with AQR. Their multi-strategy gained over 15% through the end of the third quarter. That's according to the latest Bloomberg reporting. Joining us now is the man himself, Cliff Asness, AQR Capital Management co-founder, managing principal, and CIO. Joins us now. Cliff, thanks so much for joining us around the table this morning.
Thank you for having me.
So your strategy did really well, and a big part of that outperformance was the fact that you're global. How different would things have looked if you were focused on just U.S. markets? In other words, are U.S. markets untethered from fundamentals right now?
We actually made money in both markets, but we did make more money ex-U.S. So it was an overall good year. The U.S. was more of a momentum year, though that can be exaggerated. Momentum when a quant does things, it's not just like, let's buy the Mag 7 or AI. It's like 1,000 stocks that are doing a little better fundamentals and price versus the others. So that was a little bit more of it in the U.S. The U.S. value suffered a little bit more, and that's often the flip side. But a lot of the other things we look at, some modern techniques like using ML to parse corporate statements, is it good or bad news? More profitable stocks beating low profitable stocks. They all complemented momentum. So, I was actually particularly pleased with this year because this has been going on about 5 years, so we've been on a good streak. But we had a tough period when value was really hurt in the culminating in COVID. And we did make a whole bunch of evolutions to hopefully be less dependent on that. And I feel like we're seeing the fruit of that.
You did tell the FT over the summer that you're giving more of your autonomy to the machines, right? You're letting the black box do the work. It kind of made me think of Jim Simons, right? Because he would always say, I don't know why it's telling us to do this, but we're making so much money. Is it similar with you?
Well, any comparison to Jim Simons, I will take any day of the week.
Yeah.
And in general, I tell the truth on Bloomberg, and I lie to the FT. So that quote bugged me a little bit because I actually tried to say something a little subtle. I'm pretty sure what I actually said was something like, we're giving more of autonomy to the machines. And it kind of came out as we're just surrendering whatever. We've always prided
They did use the word surrender. Yes.
We've always prided ourselves on kind of an even split between economic intuition, understanding what we're doing, and then hard data saying that this really works. Once you move into AI, you use ML to generate your signals. At some point, we can get pretty intuitive. We can understand why in general it's working. Jim Simons maybe was even more full automated than we are. We're still looking for intuition, but there are almost always some steps that we can't fully explain. And this bugged me. And I probably slowed us down on AI for about a year or two, just being the old cynical man saying, you know, when you've had a philosophy that's worked for you for near 30 years, altering it is scary. But somebody said on the team, which I thought was just brilliant, it's such a simple statement. If you always got simple-ish intuition out of what AI was doing, what the heck is AI doing? Is it doing anything extra? Like we use AI, again, to parse corporate statements. I'm going to get very geeky, and you're going to get mad at me.
No, I like it.
It takes every corporate statement and represents it as a whole set of numbers that represent that. Then you do empirical analysis saying, how does this set of numbers tend to predict returns going forward? You confirm that it's very intuitive because it looks like other short-term momentum indicators. It's just better. But that stage, what do those numbers actually mean? Yeah, I get a little Jim Simons about that. And even I'm not the most tooled up guy at AQR anymore. I'm going to hit 60 next year. I know what we're doing, but there are much better people than me. And you go to them, what do those numbers mean? And they go, it works. So there is a Jim Simons aspect, but unlike perhaps Jim, we do still insist on at least having an idea of why it's working. Some intuition.
Some of that, though, is kind of replacing work I guess people could do, because you could have someone, it would take an absurdly long amount of time, but come through all of the earnings calls and assign certain values to it. What's the difference between that and what, for example, Ken Griffin has pushed back on, saying that like Gen AI can't actually produce alpha? Is it just being additive, or is it actually giving you signals that you can glean alpha out of it?
Okay, I'm always a little terrified if I disagree with Ken, but a lot of what we're using AI for is to improve existing things in spirit that we were doing anyway. Take the earnings call example. No, we're quants. We were never going to have an army of analysts, and nobody does this. Nobody can have an army of great analysts who looks at all 5,000 stocks. But quants have been parsing earnings statements forever. They used to use, and some still do, very simple methods where you have a table of words and phrases, and you just count them up. Like good phrases, bad phrases, and you get a score. And you improve that table over time. An example might be the word increasing is a +1. I hope you can see the immediate problem. If the actual sentence was massive embezzlement is increasing, that was our bad. Now, quant can survive that because if it's wrong 47% of the time, even if it looks stupid 47% of the time, 53 is still winning. What we do in AI there, we think of it's doing that considerably better. It's not magic. I didn't hear Ken's comment, but I would be with him if he's pushing back on the often overhyped kind of, we just turned AI on and let it go, and now we have a 3 Sharpe ratio. So I'm guessing I agree with him, and I'm also, I feel much safer agreeing with him too.
He said it can increase productivity, but when it comes to generating alpha, it falls short. So maybe it generates a little bit of alpha. And also, you have your own model, right? You have your own AI, which maybe is better than Ken's AI.
Well, I'm going to go with that.
Yeah.
I like that. I didn't say it.
By the way, I wonder, with all this talk, we were just speaking with Alberto Musalem from the Fed about the data blackout, right? Does that give you an edge?
That's a tough question. It didn't seem to affect us very much. It wasn't a huge few weeks, but we made money over the shutdown. Where last I checked, it could have changed in 8 minutes, but we were making money today with the. So we are supposed to be neutral to most of these things, and it did work out that way. But we did have to make a lot of kind of one-off decisions on. We lost our data source. We want to see revisions to GDP, to see it in our trend following strategies if it's getting better or worse. It was a small part of it so far. If it had gone on for a long, long time, we would have had to make some tougher decisions. Whether it hurt us because we lost some data sources or whether it helped us because it made markets do some things we could take advantage of because we're still systematic and have other data sources, I can't tell you. I can tell you it was a good, decent time for us.
I mean, these data sources, they're plentiful, but oftentimes they're expensive. I mean, paying up for a Bloomberg terminal and the data that gives you is not cheap. On the other hand, you have more AI sources.
The amount of money you can make with the Bloomberg terminal easily outweighs
of an important statement to make
We don't
alongside
skimp
that,
on Bloomberg terminals. If the main purpose on getting me on TV was to sell us more Bloomberg terminals, well done.
Cliff, you're allowed back anytime. Thank you very much for that. Okay, so you have more data, more expensive data, but AI to some degree, we're talking about just how much of a productivity boost it is. Does this increase the consolidation among you and your giant hedge fund peers, or is this a democratization moment?
You're asking very hard questions, so I'm always going to give you on the one hand kind of answers. Big firms who can spend a lot of money are going to have an initial advantage at this. This stuff is expensive. I don't know what my AWS bill is, but it's probably bigger than my Bloomberg bill. Don't tell Mike. All that means there is some barrier to entry. On the other hand, I don't dismiss that some 23-year-old genius who's great at AI can create a competitive model in their basement. Because they are much more tooled up. So I think it remains to be seen, but I think in the short run, it's probably an advantage to the established. And we'll just have to stay on our game and keep innovating so we beat that kid.
By the way, at the beginning of the year, if I had told you we're going to have massive protectionist tariffs that are totally uncertain and, a centralized kind of federal takeover of government, profligate deficit spending, record shutdowns, attacks on the judiciary, attacks on central bank independence, like all this stuff, wouldn't it have scared you away from this market? And I mean, in the U.S. specifically, we've done really well, risk assets.
It would have, and thank God we follow models and don't listen to me. The fact that sometimes when things are scary, it's a very good time to invest. A lot of the fundamentals on companies, like I said, profitable companies have beaten unprofitable companies, and we trade that spread. A lot of the behavioral biases have shown up again this year. The place that what you're talking about maybe has helped us is we've had a very good year. I keep talking about individual stocks. We've had a very good year in trend following. And trend following, this isn't perfect. Sometimes uncertainty can kick its butt too. But on average, it likes uncertainty. It's what the geeks will call a positively convex strategy. When things get weird. Yeah, I know. I dropped the convex word.
Where's Tom Keene?
So I think it's probably net helped us. It's one of the reasons I like trend following strategies. It's self-serving. We do them. It's a product line of ours. But I like them a little more than average because I think the world has a little more uncertainty than average. You can measure that, actually. You can look at forecasts and say, are we missing forecasts by more than normal? One piece of uncertainty got resolved, hopefully today, but that's only one. But I don't think that at the beginning of the year, it would have scared me. And had we listened to my fears, we'd be having a considerably worse year.
There have been some weird things. For you, trend following has worked. For others, it hasn't. I mean, we've gone through periods where junky kind of stuff does incredibly well, and then that quickly reverses, where momentum has worked really well in gold, and all of a sudden that reverses. A lot of people have been caught out in that. Is there some degree where markets do feel untethered to fundamentals? Because this summer you said we're back to rational investing. Are we still back to rationality?
I wish I remembered everything I said.
It's okay because we do.
It would make this stuff so much easier. Trend following, you threw me kind of a hanging curveball. I appreciate. I'm going to summarize your question, extremely self-serving. Why is your trend following doing well when others are suffering? With an admitted humbleness that even if I think ours is better, and of course I do, or else why would I be doing it? There'll be times other versions will do better. But in the last 5 to 10 years, we've really expanded what we do in trend following. Trend following traditionally was price trend. They varied. Some people use short-term trends. It went up to anywhere between 1 month and 1 year for the big four: major equity markets, major bond markets, major commodity markets, and currencies. Two things that we did was a huge research effort. One was price trend is only about half of what we do now. The other half is related to price trend, but it's fundamental or economic trends. Are things actually getting better? They go the same direction a lot. They're similar in spirit, but sometimes the price moves before the fundamentals, and sometimes the fundamentals move before the price. And the fundamental trend has worked really well this year. The other one is we've gotten really into something that the industry calls alternative trends. The deeply quantitative term for that is weirder trends. So, things like shape of the yield curve, not just the 10-year. That's been a really good trend following strategy for us this year. We trade, trend following is almost exclusively, the whole trend following world doesn't trade individual equities. We do. We trade the long short factors from quant equity. They tend to trend also. So in our trend following, we trade those, and that's been really good. So again, I joked in the beginning, I am bragging, but I know at some point pure price trend will have a phenomenal year, and things that I believe are better for the long term will make us lag too. But so far so good. For a number of years, these changes have really made it better for us.
All right, we're going to take a quick break here to pay some of our bills. Cliff Asness, AQR Capital Management founder, is sticking with us. We're going to get his macro outlook for 2026 when we come back, and more. This is Bloomberg Open Interest. This is Bloomberg Open Interest. Still with us is Cliff Asness, AQR Capital Management founder, managing principal, and CIO. We had on here last month Paul Tudor Jones, who was saying this October, well, it was October at the time, looks very similar to October of 1999. And of course, the debate about whether or not we're in a bubble with this trillions of dollars of AI CapEx plans has been coming up a lot. What's your take on that?
Sure. Well, first on the specific AI, you generally don't go to a quant for a handful of stocks. Any handful of stocks can end up being worth it no matter what its price now. If I answered as a person instead of someone running AQR's models, I have a personal bias towards cynical, curmudgeonly value investing. So when I see just very high nosebleed valuations that need tremendous growth going forward, I personally, someone put on a little disclaimer, this is not investment advice, even though it so clearly is. I would personally at least fade that somewhat. I wouldn't, where I would be scared is a retail investor putting all their money in something like this. But I don't think we can come up with a firm opinion. In most things like this, what seems to happen is that the technology turns out to be very real. I mean, look at the internet. It's not like the dot-com bubble burst because the internet turned out to be a flash in the pan. It was just the companies were priced ridiculously. And also, by the way, they weren't the companies that actually mostly stuck around to win. It was Google and Netflix and companies that weren't part of. So my gut would say we're probably going to see something similar. Now, the way quants look at it, and we look at a spread between cheap and expensive stocks. You can use a real simple model. You can go to Fama and French and use just price to book. Or you can build a very subtle model that accounts for growth differences. At the end of 2020, at the end of COVID, we saw that spread the highest ever, higher than the dot-com bubble. I would jokingly, it's a math joke, but I'd call it the 125th percentile. The joke, of course, is there is no 125th. It's just the new 100th. But I'm trying to convey that it's even more than the last one. The way we measure it, and a lot of others, that's still quite wide versus history. This spread between cheap and expensive. But on my scale, it's like 75th to 80th percentile. I don't scream bubble at that. I scream bubble twice in my career. The dot-com bubble, and probably about a year too early, because you're always a year too early, in 2019. I wrote a piece, first one like this in 2019, saying, we're doing a little bit of extra value because things are nuts. Round trip, I think that paid off for us, particularly in long short funds where we didn't have to take anything else down to do it. but it's a hard way to make your living. So in the way quants look at bubbles, I can say we're in an expensive spread. People are paying a lot for the stocks they like, more than they usually do. That is on average a good indicator for value. It has not worked yet, and I would not say it's at bubble levels. Last thing is the overall market. The Shiller Cape is used all the time, and it is not far from perfect. But you look at a lot of other measures too. And for the Shiller Cape, we're approaching about a 40. It hit about a 45, a 46 in March of 2000, which was by far the highest we've ever seen. Maybe those famous words are right this time, that this time is different. But that gives me some nerves. A very high, by the way, valuation doesn't mean a crash is coming. It might just mean a disappointing decade. One of the dangerous things is if someone says markets are expensive, so I'll short it. And then what you get is you get positive returns for a decade, but half of what you normally get. It's not much fun to go to your client after 10 years and go, well, we lost you money for 10 years, but we lost you less money than we would on average in the prior 100 years. They don't like that.
Well, this is the thing of just how much is riding on the AI trade. I mean, you can look at it through the economic lens with increasing amounts of the GDP being spent on CapEx for the AI players. Retail investors who are participating more than they ever have before. Vad Tenef of Robinhood was talking to the FT today, basically saying we're going to allow our retail investors buy pieces of private AI companies.
Everybody wants private.
Yeah,
Everybody, is this something?
I already tweeted sarcastically about that.
Okay, so you don't have anything to add, I guess.
About it. I would like to remind people that bookies are not fiduciaries. Sorry, that was a
no. Well, but that sarcasm gets at a bigger underlying point, right? That there are trends that you as a human are concerned about.
Yeah, I like that we've made this. This is me who did this distinction of me as a human versus someone who sits on top of models. I will say this: whether AI is in a bubble and whether retail is fueling that bubble is a huge issue for the overall market. For me, it's much less of an issue. Our portfolio tends to look like 1,000 longs and 1,000 shorts. We are mostly, not entirely, but mostly industry and sector neutral. I can tell you, if you look at the Mag 7, I haven't looked at the AI stocks recently, but if you look at the Mag 7, we're long and short some of them. It's not a net. Our model's not entirely value, and we compare them to each other. So a concentrated market can mess up a traditional manager. It can squeeze out. One way a traditional manager makes their money is by buying good stocks, but it's also by avoiding bad stocks. But if the bad stocks all have tiny weights because the market's been squeezed and most of the weight of the market is up here, you can't really make your portfolio. You can't get a lot of relative performance out of not owning something when it's already minuscule. So there are scary things about being a long short investor. You're more susceptible if there's a short covering rally or whatnot. But one of the really nice things is we're pretty immune to these kind of issues.
I want to ask, we talk about private companies in the sense of OpenAI, like selling pre-IPO shares, but there's also private investment, which has sort of monopolized our time.
Yeah.
This year, Dani was at the center of the cockroach debate, so.
Better for worse.
What do you think about mom and pop retail investors getting access to these supposedly, like in terms of private credit, they say returns are high and stable. Like that sounds good to me. And
I think you know my answer.
Yes. But why? Because if CalPERS is doing it, shouldn't we all be able to?
Millennium and Point 72 are also getting into private markets too.
You won't. I'm scared of making predictions. I'm scared of saying AQR is not going to do this, and then 2 years later you have me in, and all I want to talk about is the new AQR private fund. I'm not above that kind of hypocrisy in the future, but I don't see that as our comparative advantage. I don't think firms should do everything they can raise money at. I think they should do everything that they think they're relatively good at. And I'm not disparaging these firms. They're very deep and they see a lot more things than we do. So they might be good at it. I've been a cynic on privates in general, not that it shouldn't be a major investment asset class. We need private investing. We need things in between public and mom and pop. We need the bid from privates for public companies that gets too cheap. We need venture capital. So they're not going away. But where I've gotten on my sarcastic high horse is the idea that they're much less risky. And that is extremely prevalent. you see a lot of institutional investors who produce a so-called efficient frontier, where they'll list like public equities at 17% annual volatility, private equities 6% annual. And all they are owning is a concentrated, slightly levered portfolio of equities. So what I worry, and I don't want to be elitist, but I think mom and pop is probably more susceptible to not realizing this disconnect. And it can lead to two things. It can lead to loading the boat with equity risk. And private credit is a little bit of a different thing, but it can lead to loading them because you don't think it's really risky because you buy these numbers. And it can lead to overpaying because even I'm not quite old enough for this, but in the 80s, David Swenson, pioneering privates at institutions. If you go read his book, Pioneering Portfolio Management, all he talks about is the illiquidity premium. I get paid to own these things because no one else wants to, because illiquidity stinks. If I'm right, and I have advanced this hypothesis, but it's admittedly a hypothesis, illiquidity is actually prized by many people because it makes it easier. You don't have to show, oh, AQR is down 5% that month, but they made 10% next month. Oh, that was scary. The private did the exact same thing. You just didn't see it. It can make you a better investor. I admit that.
I think you've called it the illiquidity
discount.
Liquidity laundering, I think is what
I've called it volatility laundering.
Volatility laundering.
I was trying to avoid being that mean on camera.
We're going to have to end it here, though, Cliff.
But that ship has sailed.
Perfect.
We're going to a break.
Cliff Asness, thank you so much. Investment bankers are bouncing back from a rocky start to 2025 and are on their course for the best year since 2021, with announced global deal value standing at almost $4 trillion. Joining us now is Rob Brown, CEO of investment bank Lincoln International. Rob, great to see you this morning. I'm sure you're happy with that volume that's been coming out of markets. How much of this is just a delay and catching up versus real sustainable uptick in M&A?
I think it's a little bit of both. And as you pointed out, deal value is up materially. Deal volume is not up that much. And so what we've seen in the past, when the M&A market recovers, the mega deals, the larger value deals happen first, and then it works its way more into the private capital market. So I think some of this is the stock market's at an all-time high. Public companies are at a point where they don't have the organic growth to necessarily sustain those multiples, and they have to go out and buy growth. So I think that's driving a lot of the mega deals, which you see in the deal value. I think what it's starting to do, though, is work its way down to the private capital markets, where you have a backup of deals given the low level of activity there.
So that's adding to, I mean, when we talk to corporates, to leaders, to CEOs, they say they just have more confidence due to the regulatory environment. It's much easier and at least not getting worse, I think is what Ken Griffin said. So the private capital aspect adds to that to sort of amplify the M&A that we're seeing.
I think that's true. I think we are in an administration that is much more M&A friendly here in the U.S. And I think the other thing you're seeing is, in the private equity world, in the private capital markets, the high quality businesses, the A assets or the A plus assets, those have traded just fine over the last 3 or 4 years. What it really haven't traded at all are the deals bought at the peak of the market that haven't performed well. And I think this year, unlike 23 and 24, we're starting to see some of those deals come to market and get done, where the value gap has the buyers and sellers are able to meet. The sellers are saying, listen, I got to get rid of this. I've got to put new money to work. I've got to move on. And so that is adding to an improving M&A market. I don't think we're in a great M&A market yet overall. I think the mega deals are, but we are clearly in an improving M&A market.
Rob, it kind of reminds me of what Scott Kleinman of Apollo told Matt and I, that a lot of these expensive deals are still making their way through the system, and because of that, things will be slow. So if a lot of those were done in 2021 and 2022, you're looking at an investment horizon where you really don't see the bulk of that come to market next year or the year after. Rob, when they do, just given how expensive a lot of these companies are, is it going to be painful? Are we talking about funds taking a big hit on valuations when their hands are finally forced to sell these things?
I think we are going to see some of that. And you're starting to see these come out now. And I think the hope, and maybe the hope and the prayer with some private equity groups, is my stars can offset these things. And if I can sell enough of my stars, then I can start bleeding out some of these deals that I overpaid for. But as you point out, I think at some point, I think we felt this way too. It was going to be like the dam breaking loose, that at some point these businesses are held so long, they just have to come to market. I don't think that's going to happen. I think what you're seeing is what you're seeing now. Is you're starting to see that open up. You're starting to see private equity sell some of these not at great returns, but they can show that the fund overall. I think some funds, if you don't have the stars, and if you put too much capital to work at the peak of the market, you're going to see some of those funds go away. But a private equity fund going away is like turning an oil tanker. It takes a long time. But I think there is going to be a shakeout, and there's going to be some winners and losers over the next several years in the private capital markets.
Do you see any deals where, Dani and I have been talking about this FT piece on OpenAI, which said they're doing some deals without investment bankers or lawyers. And, the idea is they have a high valuation now and they want to get things done quickly, just in case they have a low valuation later. Do you see that anywhere else?
We don't see that a lot. I mean, I think occasionally if a business gets approached and there's a unilateral or a bilateral negotiation, people may work without a banker if they're saying, hey, I've got one buyer, it's the best buyer, let's get this done quickly. But I think if you want that competitive tension in your process, and ultimately that's the difference between a good outcome and a great outcome, I think you want to work with advisors that are going to keep that competitive tension all the way through to the end.
Rob, I would love to get your take. We were just speaking with Cliff Asness of AQR about some of his peers, decidedly not AQR, but some of his peers in the hedge fund world. Millennium, 0.72, starting to offer and fundraise for private capital, be it credit or equity. It gives echoes of years past when the Tiger Cubs, for example, started to get into private equity, and a lot of them struggled on the other side to offload assets that they had bought at expensive valuations. What does it say to you about the overall environment when you have, I don't want to call them tourists, but it's kind of the only word I have at the moment, when you have people who are traditionally not doing private capital trying to get into it?
I think it's a trend that's here to stay. I mean, I think if you just step back for a minute, the number of public companies has decreased over the last 10 years. The number of private companies, the number of companies held by private equity or other investment vehicles, that's grown. And so, and it's shown to be, and I listen to Cliff, and I think Cliff has some great insights. I do think that there's a little bit of hidden volatility. I do think that the private markets are more opaque. But I think the Main Street investor or the retail investors, being able to participate in private equity, I think that's here to stay, or private credit or private capital markets, however you want to define it. It's just too big of an asset class. And clearly right now, as some of the institutional investors are tapped out because they haven't gotten the returns of capital they needed, people that are looking to raise money are looking for, where is the money? Well, the money's in the retail area. But I do think, there has been a trend over years of retail investors finding a way to get into private equity. It may have been through a holding fund. I think the current tide is making it a lot easier, but I don't think that's a tide that's going to turn back. I think like anything else, you want a balanced portfolio. You don't want to go too heavy into any one asset class. But I don't think this is a fad or a temporary thing.
Rob, great having you on the program. I hope you can get to us if you come to New York at some point. Rob Brown there of Lincoln International. We hope you survive the snow of Chicago as well. Let's get a check right now on the markets. We're looking at gains here as investors feel more confident that this government shutdown could come to an end. You started to see signs of this on Friday afternoon into the close, and there's been talk all weekend of it. I don't still understand how it'll work procedurally, because apparently any senator can throw a wrench in the works. And there certainly are a number of senators that are against this deal.
Yeah, but maybe just the volume of flights canceled was enough to convince them to cave or come to the table, or whatever this deal actually ends up looking at like. All right, some of the single stocks that we're watching at this hour. Health insurers on this very same news. Centene, Oscar, they're falling. Lawmakers are moving closer to ending the shutdown without a health care extension, but there was some reporting that maybe being promised to the Democrats is to revisit the health care insurance later in the year.
Shares of Metsera tumbling after Novo Nordisk pulled its bid, paving the way for Pfizer to close on its deal to purchase the former. Why would Novo pull their bid? There's great reporting on the Bloomberg terminal.
It might have a little something to do with this American government. Elsewhere, TSMC's monthly sales growth came at the slowest in 18 months, but everything is rallying today, so TSMC, along with the other big cap tech, is rallying this morning.
Coming up, Bernstein calling prediction markets a viable asset class. This gives them one more stamp of approval. We'll talk about the rise of prediction markets with Ian McGinley. He's the former director of enforcement for the CFTC, now at Sidley Austin. This is Bloomberg Open Interest. The prediction markets are getting a fresh stamp of legitimacy, with Bernstein calling them a viable asset class. In a Bloomberg Law column published last month, Ian McGinley of Sidley Austin wrote, quote, "The latest frontier in prediction markets is sports event contracts, which allows users to place money on the outcome of games, individual player performances, or even the result of individual plays." He joins us now. Ian is a partner at Sidley Austin. He's also the former director of enforcement at the CFTC. Ian, thanks so much for joining us. I guess I have to start by asking, what were you doing at the CFTC? What was that institution doing during the Biden administration as this, gambling craze continued to accelerate in the U.S.?
Yeah, right. So the CFTC regulates futures and swaps, events and other things. Swaps are considered, event contracts are considered swaps. So the CFTC was deeply involved in this issue. The CFTC tried to prohibit event contracts on elections. And there was litigation on that topic, and ultimately the event contract prediction market prevailed in court, and the CFTC dropped that case. So now you have really a rapid growth in prediction markets, as you noted, right? It started with elections, and we saw it in the 2020 elections.
And that was what, Kalshi? It started with Kalshi, and now you've got Polymarket and all different kinds of companies coming in with it.
Yes, and there are a number that self-certify almost every day with the CFTC to join the space. And now you see the next frontier, as you noted, is in sports. And so we've seen a lot of the big prediction markets offer event contracts on games, including individual performances. And you mentioned the article that I wrote. We talk a lot about the explosion of prediction markets and how it's so entertaining and it's fun. You can take out a contract on almost anything, what we say on this broadcast, for example. But you can also predict or bet, when it's sports betting, on individual performances. And that's where we've seen some of the risks. A few weeks ago, there was a big case out of the Eastern District of New York involving prominent NBA players and affiliates for inappropriate gambling on performances. And just yesterday, in a similar case out of the same office, and these are just allegations, by the way, they haven't been proven yet, there were charges that 2 major league pitchers manipulated their performance in order to win on specific sports bets.
Insane.
And you look at some things, Matt and I were looking at this right before the Nobel Peace Prize winner was announced on Polymarket. All of a sudden you saw the contracts picking up for the eventual winner even before she was announced. So it's not even just sports. You see it kind of in all these different corners. What can and should be done to make sure that bad actors can't do things like that?
So that's a great example, and it's one that got a lot of publicity. I think it shows a few things. One, these markets are very transparent, right? Folks picked up on that very, very quickly because the markets are watched closely. In the Major League Baseball case that I just discussed, analytics apparently caught some of the bets as being anomalous, and it was elevated up. But I think, when I look at different markets, right, I was a federal prosecutor for about 10 years, the head of enforcement at the CFTC. Every asset class has the same risks, whether you're talking equity markets, sports markets, crypto, right? There's risks from insider trading, as you mentioned, right? People sharing information or taking information that doesn't belong to them and passing them on to someone else. So in this article, we talk about a lot of common sense, everyday bread and butter compliance solutions. And those include, what you might imagine, right? Training. But when you talk about prediction markets and sports and betting on anything, whether it's sports, Hollywood awards, a whole new class of people need to be trained and steeped in these concepts, where if you are, and a lot of the prediction markets, by the way, have included this in their policies, they have a hard ban, where if you are a participant in a committee or in a game, you are prohibited from participating in the event contract on it. And that is smart. Training, awareness, right? I think Charles Barkley, when he was talking about the NBA indictment, said, well, everyone knows, that this conduct is prohibited. But I think there needs to be greater awareness as these cases show.
Does the current CFTC, or do regulatory bodies now have sufficient understanding of the types of liability that these markets can be susceptible to, do you think?
Well, the CFTC has always regulated designated contract markets, which is what prediction markets are, right? And so there is a core competency in that. These are new markets, though. In terms of sports, they've really only grown over the last 10 or so months. So there's always, from an institutional perspective, there's always going to be a learning in terms of getting expertise.
Right, and nobody
understand.
at the CFT is running analytics of, fastballs, right?
Probably not.
Not yet.
I'd say that's fair. Not yet. Yeah, I would have if I was still there.
Sounds like a good time. I was going to say, okay, but so this is one risk, right? Insider trading. The other one is just like the riskiness of this idea that an everyday person could bet, I don't know, like liquidate their 401k and bet it on how many times the Chipotle CEO is going to say carne asada in their earnings call feels kind of crazy. What do you do just about like the very large risk and very, gambling aspects that there are to some of these prediction markets?
Well, you have to. It starts with having awareness and strong policies and procedures. And then, there are enforcement cases, right? Now, I would bet after, no pun intended, after these recent indictments that have come down, it has raised a lot of awareness about the risks of participating in these markets. And so anytime that there is an enforcement case or an indictment, as a prosecutor and a regulator, you are thinking not only about the individual case, although that is your biggest concern, but also the deterrent value of the matter. So as you see problems, and if there are cases, if the facts and circumstances support that, I think that will deter misconduct.
But you're not making, it's important to point out, you're not really making a moral argument about gambling in your piece.
No, the point of the piece from my background is I've looked at markets, equity, crypto, sports betting markets. All markets have similar risks, right? This is a new market. And so people should be aware of those risks. And then companies and firms entering it should take precautions because there is liability, right? The prediction markets are now registered with the CFTC. When you are registered with the CFTC, you have obligations because it is a regulator, right? You have to make sure your contracts are not susceptible to manipulation. Make sure there's no abusive trading. So those are obligations. And by the way, if you fail to comply with those obligations, there is liability not to the person placing the contract position, but to the organization. And so that was the point of the article.
But what happens when you have like one of the betting markets being like Truth Social of the president and his company getting into it too? Surely that influences regulators on just how forceful they might be with some of this.
Well, I can't speak to that particular market, but I'll say it shows how much prediction markets have grown with time. And you mentioned the Bernstein report about saying it is a permanent asset class, or going to be. And I think you see it now in almost everything we do. And you see why it has grown. I watched the election returns last week. And you watch the news, but then you also watch the prediction markets. And if you followed the prediction markets, similar to the 2020 presidential election, they were calling the favorites, not calling, but they were showing the favorites for a much earlier time than traditional sources.
Ian, this has been so interesting. You have to come back and join us. That's Ian McGinley of Sidley Austin and the former director of enforcement at the CFTC. And you can find articles and Ian's specific article. Highly recommend everyone go read it. B-Law, B-L-A-W, on your Bloomberg terminal. That's where you want to head to read that. Coming up on the show, the Senate is set to reconvene at the top of the hour as we gain some momentum towards ending the government shutdown. We head to Washington, D.C. next. This is Bloomberg.
I don't think it's coincidental, you know how I think, but it's after 40 days of wandering in the wilderness and making the American people suffer needlessly some Senate Democrats finally have stepped forward to end the pain. It appears to us this morning that our long national nightmare is finally coming to an end, and we're grateful for that.
That was House Speaker Mike Johnson. The Senate is expected to reconvene at the top of the next hour, potentially moving us closer to end one of the longest, or not one of the longest, the longest government shutdown in U.S. history. And just moments ago, President Trump took to Truth Social, writing, all air traffic controllers must get back to work now. Bloomberg Washington correspondent Tyler Kendall joins us with the latest. Tyler, how close are we to ending the government shutdown?
Hey, Dani, good morning. Well, we're definitely closer, but it is not a done deal yet. So far, the Senate has advanced this legislation that would fund the government through January 30th and some key agencies through the rest of the fiscal year. That's important because one of those agencies is the USDA, which means, in theory, the issue of funding SNAP, which has been at the center of some of the pressure points, would be resolved through at least next year. This also importantly reverses mass firings of federal workers that started on October 1st and, in theory, protects against future firings through at least January 30th. But we could see some pushback in the House when it comes to that provision, so we're watching that carefully. And then finally, there's a promise on the table here that there's going to be a vote on extending the Affordable Care Act premium tax subsidies, but only after the government reopens. Our understanding is that vote will take place by the second week in December, but that doesn't mean that that's going to pass. And that could also prove to be some trouble in the House, because although the Senate advanced this on a procedural vote, it still needs to be up for debate in the Senate when they convene shortly and then pass a final floor vote. Any one senator could tie up that process, but we are widely expecting that this legislation will advance out of that chamber. But then House Speaker Mike Johnson still has his work cut out for him. He still needs to convince some Democrats to get on board and some hardline conservatives that are already raising concerns about some of the spending levels tied to this legislation.
Yeah, I also thought it was interesting that he appeared to be referencing the 2002 Josh Hartnett film 40 Days and 40 Nights. I want to ask about the Supreme Court rejecting a bid to overturn the same-sex marriage ruling. Did they offer any comment with that?
No, we actually didn't get any explanation for the court's decision, Matt, but this does signal that there's not an appetite among the Supreme Court to reconsider their 2015 landmark ruling that legalized same-sex marriage. And there had been speculation that they actually might be keen to after we saw that 2022 decision reversing Roe v. Wade. And this is a more conservative court, a conservative majority, actually. 3 of the justices that were there in 2015 are no longer there. So some thought there could be an opening, but at the end of the day, they're not going to revisit it. And it means that the Kentucky County Clerk at the center of this is still on the hook for $100,000 in damages to the same-sex couple that she denied a marriage license to 3 times.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there covering the apparent or the drawdown, I guess, of the shutdown for us out of Washington, D.C. Coming up tomorrow, Joanne Feeney of Advisors Capital joins us, as well as Victoria Fernandez of Crossmark, plus the CEO of DWS Group Americas. This is Bloomberg Open Interest.